Well, folks, just as it felt like we were getting some relief in this painful stock market, which has just been straight down, we ended up crushing our 5-day rally in the NASDAQ, with today the NASDAQ being down 2%. Why are stocks falling today? Are we going to crash through now new lower levels? The NASDAQ getting all the way down to 268 at one point, sitting at just around 290 right now when we use the ETF QQQ as a tracking measure. Folks, what's next? And why are people and markets so uncertain today? A lot has to do with the numbers that are coming out this week. So let's talk about those, because it's going to give us a lot of insight into why all of a sudden stocks ain't very, very happy. And we got quite a few of unhappy campers. I mean, just take a look at this. Fastly down 13%, Upwork down 10%, Open Door 8%, Peloton another 8%, Roblox another 8%, Affirm down 7.2%. And of course, you've got Tesla also down 3.9%, following the potential that Elon Musk is going to get sued by the Twitter board. Twitter, of course, being down 6.9% at the time of this recording. So what's going on? What's creating all of the anxiety? Well, folks, the answer is pretty simple. This week, in just 2 days, we get a CPI release that is expected to be the worst CPI release yet again in 40 years. Now, it feels like we've been saying, wow, this is the worst CPI release in 40 years for many months in a row now, but it's true. We keep hitting new peaks. Yes, on Wednesday at 5:30 a.m., we expect CPI to come in at a higher rate. Previously, we had inflation that came in at 8.6% year over year, and now, folks, we expect that to not be 8.6%, we expect 8.8%, at least based on Bloomberg consensus estimates. CPI will be coming in at 8.8%. On a month-over-month basis, and remember, we can annualize this by multiplying it by 12 to get sort of an idea of the speed at which we're traveling, we expect annualized inflation to come in at 1%. And if we multiply that by 12, it implies we are still growing inflation at an annualized rate of 12%. That's pretty high. Anytime the annualized rate is actually greater than what the current inflation rate is, it means you're still trending up. And this is by a large margin, by 3.2 percentage points as a difference here. Now you might think, hey, but maybe core is decelerating. Well, not really. When we look at core, the projections for core are going to be about 0.5% on a month-over-month basis, which still means we're inflating at 6% on an annualized basis, substantially far away from the Federal Reserve's 2% goal. And a lot of folks are suggesting now that, hey, the Fed's 2% goal is not even realistic, especially since we need to consider that inertial inflation that happens when essentially more people move into renting from home buying, leading rents to actually go up, creating pressure under CPI because, well, after all, rents make up about 30% of the CPI read, and even that is flawed. It's the owner's equivalent rent, which lags by about 6 to 12 months. It's pretty remarkable. But anyway, even as we do see some of these items come down, we get out of peak airline travel season, we could still see inertial inflation hold these inflation numbers up. And unfortunately, it's not a good thing. And that's the read that comes out in just 2 days from today. Of course, today we did have small business optimism that came in low, but I don't think that's really what's moving markets. I think this is a typical sell the rally kind of market rather than buy the dip. We're selling the rip because folks expect that CPI number is going to be pretty miserable on Wednesday. Now, some say, don't worry, that bad CPI number is already baked into the cake, and what we're really expecting is that the Wednesday number will officially be our peak, and then it'll be down in glory from there. Sure, and that's what we said in March and April. In March and April, we said, oh, well, the March numbers are going to be peak, and so we got our peak March numbers, and then what happened? April numbers came in lower, and we're like, see, look, the peak is over. And what happened right after that? Inflation came in higher again. Come on, folks. It makes it very, very difficult to get happy anytime we talk about inflation. The only thing that makes people happy these days is the fact that you can get lifetime access to the programs on building your wealth. It's for a bargain. 50% off using that coupon code linked down below, and you can take advantage of that coupon code before it expires and before those prices go up, because the price goes up about 2 to 3 times a month. So take advantage of those price increases. The price doesn't come down, and that's because we're on the path to getting the value of these courses and the prices of these courses in line, which we believe the value of these courses is anywhere between $3,000 to $4,000 to $5,000. And right now, for many of the courses, you're paying less than $1,000. So check those out. Use that 50% off coupon code, and we'll see you there in those private live streams where we do fundamental analysis as well for stocks and real estate. So then on the 14th, so we have CPI on the 13th. On the 14th, we're going to get the PPI read. And this is the purchasing price index. Here, we are expecting a gain of 0.8% on a month-over-month basis for purchaser prices and a 10.6% bump year over year on the purchasing price index. These are also substantially high figures, 10.6% year over year. So you get to those double-digit reads, folks tend to get a little bit more nervous. But I think the most anticipated read of this week is probably going to be the U of M Consumer Expectation Survey. See, we can go to the bond market pretty much on the daily basis and see what expectations are for inflation. And expectations for inflation have been falling. In fact, if we look at the 5-year break-even right now, and we do so together, the 5-year break-even right now is sitting at 2.6%. That's a relatively low level. Here it is on screen. You can see year to date, we're at almost the absolute lowest level that we have been for the market's expectations of inflation, which is great. But consumer expectations for inflation have been relatively stable. We've been sitting at expectations of a 1-year 5.3% inflation rate and a 5 to 10-year expected inflation rate of 3%. That should be down from 3.1%, but still relatively stable here, still above that 2% Fed goal. I believe if we end up getting a miss here like we did in June, where initially it came in higher and was revised down later, this could end up leading to more shock from the Fed, especially combined with what will probably be the highest CPI read in, again, the last 40 years. So these coupled together make for quite an uncertain week and could explain why there's some tumult in markets. Though, if you take a look at what commodity prices are doing, commodity prices are trending straight down. Let's take a look at this right here. Here you can see commodity prices or industrial metals in this case. This is the Bloomberg Industrial Metals sub-index, which kind of gives you an idea for pricing of things like copper or aluminum, steel, iron altogether. What we end up getting is this massive decline where we've really fallen about 61.8% of the way back down to the lows that we previously had here in 2020. The fact that we're 61.8% of the way to our April and March of 2020 lows is pretty remarkable and is showing an absolute decline in those commodity prices, which is good news, hopefully, for inflation. But it's going to take a few months for that to actually show up in inflation. It's got to get through production first, and then it's got to get to the consumer. And one of the neat things, too, is you do have analysts that are substantially bullish right now. And Bloomberg is suggesting that analysts being this bullish tends to actually be correlated with some of the best returns in a market. Some of the worst returns in a market come from times when analysts are actually not as bullish. And this is obviously creating substantial debates that we're going to face an earnings recession and that analysts are going to have to revise down their earnings expectations remarkably. But if analysts having bullish expectations might be wrong in the short term, very short term, say 2 weeks, 3 weeks, 4 weeks, they might actually be right in the long term. And this is what has me buying the dip and dollar cost averaging into my favorite positions, whether it's my M1 Finance pie, that's a more diversified pie, or it's some of my higher conviction names, all of which, including every single trade I make, are posted in the Stocks and Psychology of Money group, whether it's options or shorts or longs or puts or calls, whatever, they're all posted. Folks, something to keep an eye on. Maybe if analysts are this bullish, either they're totally wrong or they're right. And in a year from now, we're going to go, dang, we got a nice 20 or 30% return year over year. Fingers crossed. But hopefully this video gives you a little insight into some of the drama that's happening this week. And boy, oh boy, there's going to be drama.